Good morning, guys. This is the Q&A session for the Eurozone. This will be useful if you put your questions ahead of time in the right board. Then I can prepare written answers, and we can have an agenda for things to talk about. First question is, what ATR period do I use? ATR 14. Okay, I was going to show you the link to to last night's session. So I don't come to these with just generic material to lecture on, because the standard lectures are in the videos already, and these are really geared towards specific questions you may have. And it may not be the case that you have questions on a given Sunday. Um, so if there's no questions, I have work to do, and I'm sure you guys have things to do on a Sunday as well. But I'm happy to answer questions. And let me take a look at this question here, if I can read that. Let's see. In terms of X risk versus P risk for determining SQN number, use the position sizing risk. Yeah, it's going to increase your SQN because the size of the standard deviation will be small. However, it's really mathematically going to be the same thing, because your average win is also going to be factored, by that 1/5. So you're basically cutting your average win by 5 as well. So you're reducing the numerator and the denominator by the same number. So that's going to be a constant relationship. Now the SQN score is going to remain constant. What will be different will be your psychology, because you won't be as anxious inside each trade, because you realize that when you take a regular loss, it's going to be a 0.2 loss, for example, if you use the 5-to-1 ratio. And it's a lot easier on your psychology when you're taking fractional losses. It doesn't prompt you to make changes in the moment. And at the same time, when you are requiring 10 execution risks for reward, when you have a 10-to-1 reward to risk ratio factored in, that fact alone is going to screen out a lot of marginal trades. So the probability of getting bigger trades is greater. And let me show you what I mean. So if you had some kind of move like this, and then it's going to cross the dragon, you might say, hey, a reasonable move would be something that takes it back to the previous peak of the RL10. And maybe that just happened, 10 to 15 bars ago. Let's call it 10 bars. If that was a daily bar, this would be a swing trade. And what you're looking at is a return to the 10-day high. That's the number that I use to compute reasonable reward for swing trades. That's the mechanical target. And so in this case, if my execution R is here, and I can see 2 full R's up to here, then chances are this has plenty of my execution risks in here. So now what I've got is, when this thing actually works, it's not an unreasonable move for it to get this far. So maybe the average win is something like this. Whereas if I have just this kind of little move, and my execution risk here, and I've only got a 0.4 of an ATR move to get back to here. Now, unless this may have been just some move, sideways choppy move like this, and then there's some kind of really tight channel happening in here. So in this trade, above this bright blue line. So this is a separate case. What I'm locked into here is just a really tight channel, and yeah, the 10-day high is right here, but there's just not enough expected move inside that channel to make a difference. The recording will records my audio, not the choppiness. So this is not a good trade because you don't have two position sizing risks, whereas this one, good trade, has 10 execution risks available. So the fact that you're qualifying it with the with 10 execution risks makes this a good trade. And it shows you that the smaller your execution risk is, the MMRB, the better. That's going to improve your system quality number because your average win is going to be better, whereas your average win here is going to be poor. All you can hope on this one is that you're buying the one that eventually breaks out. Whereas this one, you're just getting it to return to a previous high, which is a good payoff. But the SQN is going to be the same because the SQN is the average trade divided by the SQN. So the SQN is going to be divided by 5 because you're using execution, but your average win's going to be small too. So the SQN, by standard deviation, I should say, sorry. So because you're using the smaller box for risk. See, if you were using the execution risk as position size, then if you were using execution risk for position size, let me try changing the connection, see if that helps. The psychology of this is that if I was using execution risk, excuse me, if I was using execution risk to measure my gains, the average win in this case would be 5R compared to a 1R loss. So you get a 5-to-1 ratio. And the standard deviation is simply going to look at the variation in the wins and losses. But if I'm using 0.2 as my execution risk, then and this is only a 1, you still have a 5-to-1 ratio. The standard deviation is going to be also divided by 5 because the variation is divided by 5. So you're going to get the same system quality number. The difference is in the psychology. Because what you do is, at the moment you take the trade, you will psychologically feel the loss of a full 1R. But you only experience the loss of a 0.2R when it comes to actual execution. Right. Yeah, your actual win is a 1R. So now a retracement halfway up this stack and you get a 1R win, that just feels like a normal win. Whereas if you experience that as a 5R win, you get all enthusiastic and manic. So you end up getting manic depressive if you start computing things in terms of execution R. It will cause you to experience great joy and great sorrow on each and every trade. And that will just wear out your psychology. It'll burn out your nervous system. So if you get used to just totaling things up like, hey, I got 1R, I got 0.8R, I lost minus 2R, I gained 0.6R, these just feel like going to work and collecting pieces, making little bricks. So what you want to do is you want to pile up a bunch of little bricks every day you go to work, and each one is just like the rest of them. And at the end of the day, you look back and you say, holy mackerel, I got a whole pile of bricks here. And not any single one of them contributes enormously to the wins or losses, but you get in good professional habit, and it causes you to fight for these little fractions to make small differences in a meaningful professional way. Well, you're still going to get stopped out at the execution risk anyway, whether you were measuring it in terms of whether you called that 1R or 0.2R, you're still going to exit where you're supposed to exit, because any price below that red line tells you that that hypothesis didn't work. So you're going to take that loss. You take the loss at the price, not because it went 1R. You take the loss because the price told you that that hypothesis would no longer work. So a lot of guys will just say, well, I'm going to take a 2 ATR loss on a swing trade just because that's what I've decided to use for position sizing, but not even taking a look at what the price pattern was. So let me show you that as an example. People that tell you to use 2 ATR as your stop loss on a swing trade are saying that because they don't understand what their trade pattern is supposed to do. They have some trade pattern in here and say, there's a good trade pattern. Now I'll just buy it right here, and I'll just have a generic 2 ATR loss. And then this thing, there's some kind of fogginess about the price pattern. It says, well, this thing should work, and this should give me enough. Protection that trade should work. Well, what that means is now compare that to a trade frame, which takes the following position. It says, look, I had 5 days down, 5 lower lows, and that sets up a good probability that this was a overreaction that was fueled by some reason to start selling, but then got fueled by momentum. And pretty soon, people that love that stock are going to look at this as a way to buy on dips. And so when they see that as a buy on dip opportunity, then that buying pressure comes in, and it's not unusual for that thing to go 5 to 8% of recovery over the next 5 days. So if I take this as 1, 2, 3, 4, 5, in the next 5-day period, it is not unreasonable to expect that thing to gain 5 to 8%. Historically, that's been a reasonable bet. But the price that says this is not going to happen is not just a generic 2 ATR stop, but it's this price right here. If this thing doesn't go up, but instead reverses and goes down, as soon as I see another new low, then the hypothesis for this trade is over. And in fact, the 5DD isn't working. It's now a 5DDF, a 5-day down failure, because a 5DD can very quickly, it could become a 10DD. And what I want to do is take advantage of the downward move, which was baked into the cake on the basis of the previous 5 days down. That's the much better trade, is not to just stick around and eat a 2 ATR loss, but to stop and reverse right here. Why? Because I understand the pattern, and I understand that a 5DDF is a positive expectancy trade. So for me to stay in the trade longer than this tiny little risk box would be stupid. It would be a misunderstanding of what that pattern really generates. Now, this is a swing trade pattern that has very particular performance characteristics. So what I'm going to do is use 2 ATR for position sizing, but what I'm going to do is have a very tight stop in here for execution risk. If that 5DD ended up with a tiny little doji of a day, that thing might only be a quarter of an ATR. And the 10-day high might be 10 of those. It might be 10 daily ranges of this little doji just to get back to the 10-day high. That makes this a beautiful trade, because now the size of the adverse price move is small compared to the reasonable gain to the upside. What gives me the rationale for a 0.2 stop is the size of the risk box that is framed based on the characteristics of the price action of the pattern. So if you really understand the pattern in the 5DD, what you want is a 5DD that terminates in the smallest possible daily range, because that's the mechanical range That's the mechanical entry, 5 cents above yesterday's high, and the exit is 5 cents below yesterday's low. So you want that about a quarter of an ATR. So if you get a 5DD plus a very tight range on the last day of losses, then you have an ideal 5DD because it gives you the 10 execution R compared to your risk. Now, that's a much better trade frame than just a generic up 5 days down and just use a wide 2 ATR and then let it just fail a full 2 ATR before I exit. That's a horrible idea. So what we do is we use the 2 ATR stop to position size, and then we look for a very tight execution risk. And then if this trade fails, then we stop and reverse, and then all of the move that brought it to 5 day down, we expect to get on the other side. And you're using a very tight stop there. So what you had is 5 days down, it terminated in a little doji, and now you're in a critical state. So you're long if it breaks out there, you're short if it breaks down there, and if it works, it should give you a very nice move just back to the 10-day high. But if it fails, you take a little minus 0.2 loss, and now you're short into the same size of a move potentially that was already lost. So when this one works, you quite often get a very nice trade. So you end up getting the trade that another guy takes as a 2 ATR loss. You end up taking a fractional loss, stop and reversing, and then you get the payoff that guy experienced as a full 1R loss. So how can you trade that way? Because you understand the pattern and you have a trade frame that allows you to get a very small loss when you're wrong and a large win relative to your risk when you're correct. That is what's going to improve your system quality number, not just the mathematical psychology. Although it will help your psychology when you're taking these small fractional losses. The large 2 ATR position sizing risk protects you from having too much faith and confidence in any one particular trade. You don't want faith and confidence, like believing at the start of the trade that, oh, this is the one that's going to be magic and makes my fortune, so I'm going to stick around too long. No, you don't care about that. Each trade that you take, you experience, at the moment you put it on, you experience the full one position sizing loss from an emotional standpoint. As soon as you put it on, I want you to fully experience that, man, I just pissed away another trade, another $400, or whatever your trade, whatever your dollars per standard trade is. Hey, I just pissed away $400 as one full position sizing risk. But in fact, on execution, I only lost 0.2. In my mind, every time I can execute a 0.2 loss, I got back 0.8 because I didn't have to experience that full loss. And on the upside, what I've programmed is 2 full position sizing R wins that are reasonable according to the pattern. Why is it reasonable on a 5-day down to go visit the 10-day high? Because quite often that 10-day high was just 5 days ago. And maybe that's a $5 move. And maybe this thing terminated in a tiny little doji that was 30 cents. That means I would love to see that. I would love to see 5 days down that traveled $5 that ended in a 30-cent doji of a day. Or I could go into a 1 hour chart and frame it up with a 30 cents and get and then only take a 30-cent risk in on the hourly charts. And if that thing starts working for me, convert that to an overnight swing trade. And now I've got 15R. I've got 15 little 30-cent risk boxes just to go back to the 10-day high. And a return to the 10-day high is simply, it's going to go test a double top. That's not unreasonable. That's not crazy. But what it does is it actually you only take the risk that is justified by the trade frame that you created. Yes, the doji range is the risk box, the mechanical risk box on swing trading. So the smaller the range on the day of the setup, the better you like it. And so when you have this, if you have this tiny little doji as your risk box, but the position sizing is 2 ATRs, and you're only going to take that tiny little loss instead of the full position sizing risk, that becomes easy for you to just take that loss. Because you say, look if that thing was going to work, it was going to stay above the doji, and the doji was going to be the place where it bottomed out. But if the doji fails and goes this way, well, then the easy move is to the downside. Why? Because the previous move was 5 days down. Why would I stick around? What? Because I believe somehow magically the 2 ATR is going to protect me? No, it doesn't. What's driving this thing down is all the reasons why people were selling it the previous 5 days. So now what you have is a 5-day down that terminates in a doji. You have a critical state, and it's ready to make a large move back to the 10-day high or to continue on down with the painful selling. But what it did was terminate in a doji, which said this might be a place where this thing could reverse. And if it reverses, you're going to be rewarded. But if it fails, you're going to be rewarded. And all you got to do is take a small risk and then not have a directional bias. But if people tell you, oh, that's a good swing trade pattern, and you should use 2 ATRs as your 1R, you might stick into this thing for a full 2 ATR loss when you should have been short. So the 2 ATR position sizing risk keeps you from blowing up your whole portfolio. Let's pretend that you love the 5DD pattern and you have success with it. And then instead of following the logic and position sizing according to a small fraction of your portfolio heat, you decide to take your entire portfolio, because I love the 5DD so much, and I've seen people do this. I've seen more people do this than do it correctly. God dang it. What is it? Okay. So let's say a guy does the 5DD and he specializes and he loves it. He says, man, I have like a 70% win rate on it. I'm making that number up. And he says, well, instead of risking just $400 on the position, and now there is and maybe 1 ATR is $1. So 2 ATR is $2. So he's now supposed to take 400 divided by 2. He's allowed a max position size of 200 shares. And let's say he has $100,000 in the account. and the stock is trading for $20. What he's supposed to do on this little 5-day down, and it ends in a doji, and maybe that doji is we'll call it 40 cents. Maybe that doji is 40 cents, and the 2 ATR stop is $2 full. So based on $2, he says, oh, I'm supposed to have 200 shares. So 200 shares times $20 is a position of where he's paying for. He spends $4,000 to buy the capital. He says, but you know what? I like this 5-day down so much that what I'm going to do instead is I'm going to take my whole portfolio, $100,000 divided by 20, and I'm going to buy 5,000 shares instead of 200 shares. And so he buys 5,000 shares, and sure enough, that thing goes up. It comes up through here. He buys 5,000 shares, and it goes up a little bit, and he's happy. And then it starts to sell off, and it goes, and now it goes down, and it goes through the place where he's supposed to get out. And he says, oh man, I just lost 40 cents on 5,000 shares. I'm minus $2,000. But I believe in the 5-day down pattern, and I believe that this thing is going to go back to the 10-day high like so many of the other 5DDs did. So he says, well, if I'm afraid that if I get out right now, this thing is going to, as soon as I get out and take the $2,000 loss, this thing is going to stop and reverse, and then it's going to go back, and then I'm going to be full of regret. So just this time, I'm just going to stick a little bit longer. I'm not going to get out when I'm supposed to. I'm going to just stay in. And it starts going down, and he takes a full 2 ATR loss. And now he loses $2 on 5,000 shares. Now he's down $10,000 when in his mind he only is risking $400. So that's a 25R loss for being stupid, for believing that this one trade was going to be the one that buys the castle on the hill. That's just one trade of the next 1,000 trades that you're going to take with 5DD. So to prevent that, I use the position size, the wide position sizing risk, to make sure that my position sizing is small so that I don't lose my mind on each and every trade and get tunnel vision. So I don't bet the entire farm on one trade frame. The 5DD is good, but each trade is its own thing. It's an actual trade with people in there fighting and taking it in both directions. The histogram of results simply gives you a statistical belief that this thing has the possibility of performing according to historical norms. But the law of large numbers says that you can, even with a 60% win rate, you can get a string of 5 losses in a row. So I only want that to be the execution risk, not a full position sizing risk. So you use the execution risk in the trade frame to protect you from losing your mind. And then because your emotional level is a small investment of emotions, you can execute that thing according to your risk like a professional. And you can take 5 or 10 or 15 or 20 trades a day if you're a day trader without burning out, without violating your rules. And that'll keep you in the game for 5 years. All right. Yeah, the doji is on the daily trading report. The size of the daily range. You can see that on the Dow Tactical and the ETF Tactical. I track that for the 60 stocks and ETFs that I trade routinely. But that number is available on any broker if you're trading instruments other than that. That's why the time-saving value of the TC2000 bundle for $5,000, it automatically computes the reward to risk ratio on every single trade pattern that I use for swing trading and day trading, and shows you that on a chart. And it lets you sort all of the candidates. So you could run that thing on 5,000 symbols if you wanted. So the time savings and the staff work that the TC2000 bundle represents, what is your time worth every day? My time is worth $500 an hour. That thing saves me 10 hours a week. That the TC2000 bundle, for me, pays for itself in a week because I don't have to do that work. It does all the math for me and shows me what the best candidates are for all the symbols that I'm interested in. So you could scan 5,000 symbols on my Excel spreadsheets, and things that I restrict my trading to are the ETF 30 and the Dow 30 bundle, or those packages plus a couple specials, because I specialize in them. So I don't look at 5,000 symbols. But that's just because of that's just my style of trading, how I've adapted it to myself. So the trading reports that I produce are the ones that support my style of trading, but the ideas are large. So as you start learning these patterns, you ought to go take a look at the TC2000 bundle and realize that thing is a steal at $5,000. That thing is a steal for how much money it saves you, if these ideas resonate with you. But don't buy it until you've gone through the course and you understand what the underlying patterns are, to decide if the bundle is going to save you time and effort and automate your planning and preparation on patterns that you want to trade. So there's time to do that. Don't spend the money on the bundle until you're satisfied that the patterns and the ideas are the kinds of things that you want to trade. Yeah, that's exactly. So yeah, that's the attitude I want you to have. Buy a time-saving device if it'll actually save you time, and you got to take into account if this is the kind of trading that you want to do. So as an example, I think your idea of doing the SSC and the collapsing dragon, just proof that pattern. I'd start on that one right now, and be paper trading that every day for the next 3 weeks. And if that works for you, then look at expanding time frames, adding symbols to it. And if that works for you, on paper trading, start trading it live with one share. And then after you trade 50 times live with one share, for what's the commission that you pay on one share? If you're trading at Interactive Brokers, it's a I don't know, a penny or $1. So you could spend $50 on 50 trades. Zero on TD Ameritrade or Thinkorswim. So for a cost of zero commissions, you could make 50 live trades with one share after you've mastered the pattern with paper trading. And then you would know. Now, I would take that evidence instead of some kind of computer-generated backtesting. Backtesting, in my view, only gives you confidence that you can trade it forward. But I'd trade it forward 50 times with one share to see what it actually feels like when you have skin in the game. If you have the discipline to do that, then you can start to scale up. Then you can start risking $25 a trade. $25 a trade with a 25-cent initial risk, intraday, for instance, means that you're trading about 100 shares. So scale from one share to 10 shares to 25 shares to 50 shares to 100 shares. And you will have accumulated enough actual trading evidence to tell you if that style of trading is good for you. Think of the money you'd save by doing that instead of buying another trading system for $5,000 or taking a workshop for $5,000. Then, if that works for you, you could consider the TC2000 bundle in order to automate finding those patterns on hundreds of symbols. So you'll always have SSCs that are developing. And then you can catch them as they're making the big sell-off move. And then you can just watch and wait and see which one of these 10 symbols is going to make a reversal in the RL10. Which one of these crosses the dragon next? And then you pick the ones where the signal's firing. And that way you don't fall in love with any one particular symbol, but you just manage the pattern and you use the TC2000 bundle or program it yourself in Thinkorswim, and then just specialize in that very robust pattern. So that's the idea. That's $1 million idea, by the way. All right, other questions? I would eventually you could, yeah, you could after the SSC, but you can also do Kata 2 even if the first trade was not an SSC. So the difference between them. So an SSC requires a significant sell-off. Why isn't that working? Yeah. So in the SSC, you require a winter MACD histogram. The RL10 reverses. It will cross the baby dragon. The winter will turn to spring. The RL10s in the spring will cross the dragon. The PSAR, which had been tracking this all the way down, will flip approximately the same time that the RL10 crosses the dragon, and then that becomes your entry. And then your risk box, you figure out, actually the PSAR mathematically flips exactly where the RL10 bottoms out. Oops, let me erase that. So then your risk box is from the entry. Sorry. That's your execution risk. And your price target is going to, wherever that last resistance was, whatever, see, there was some price level, some fair value price level that was up here prior to this great big sell-off. So prior to this great big sell-off, there was some fair value. So the worse this winter was, that's a big bad sell-off. It created a winter in the MACD. And then what you'll see is that there are so many of these risk boxes to the upside that all you have to do is, the next decision after you enter is just get your risk to no lose plus dinner for two. And then it's just a science project to discover, hey, I wonder how much money I'm going to make on that. Because when you entered here, and then you get your risk up into here, you've already banked that move. So you eliminated the risk to your core capital. This is the open risk. Open risk. That is risk to your core capital. Once you move to no lose plus dinner for two, that risk is gone. So that's the SSC, supported spring crossing. QAw02 simply says that when in a bullish move, it's not unusual to see all that. And, in that kind of a move, you'll see the PSAR will look like that. And it's not unusual to see the dragon is quite often floating along like this. And the Bollinger Band mean in the middle of the river is usually down here like that. And in a strong grinding upward bull on any time frame, it's not unusual to see that those lows, these little dips, people keep buying those dips. And it never gives you that strong sell-off that is needed for an SSC, right? See, on an SSC, you see that big strong sell-off is what creates the opportunity for recovery. So the worse the sell-off, the better this potential recovery, and you're only taking a small risk based on the fact that it has already started to reverse. So that's this pattern over here. You really want to see a huge sell-off. But, for like a swing trader, what you would love to do is to be hooked into some kind of thing that just keeps grinding up. So when you see a strong bullish move, it's in a trend, and it has a pullback and then a recovery that made a new high. Here was the previous high. And now it made a new high. That's the definition of an upward trend. So when I see a high, a low, a new high, and a new low forming on this little curl right there, I want to buy that. And then if it takes out this move, I've locked in a gain. And now this thing can keep, and so at every one of these, I can just, as long as it keeps doing that, as long as it keeps making new highs and higher lows, I can keep adding positions in here on the basis of risk and reward and QAw02. And then I just have to have some long-term estimate of what is a fair value to the upside. And I have other ways and means of doing that. But if you think about the image I showed yesterday on PBW, this kind of mentality, we got into that early because it was a blended monthly rebalancing, a core position ETF. And that thing just kept doing this. And so we then put a turbo on the core. We said, let's go into a swing trade time frame. And on this basis, as additional swing trades, we just kept buying QAw02 entries until we got 5 or 6 positions. And then the first position gained 400%. It went from 30 and it went as high as 140, but then we exited at 120, which is a pretty wide stop. But each of these additional positions made that a massively good trade. So can I quickly define X risk by distance from entry to the PSAR before entering? Yes, absolutely. Because as this PSAR starts moving down, right? As the PSAR is moving down, the RL10 is moving down. Then the RL10 reverses, and you already know what the low point of the RL10 is. And if this thing keeps reversing enough so that it crosses the dragon, it's going to make the PSAR flip. And when the PSAR flips, it's going to come back to where the bottom of the RL10 was. So as soon as the RL10 reverses, you already know what the bottom of your risk box is. Hey, guess what happens if this thing doesn't even cross the dragon and starts to fail again? You just short it again. And then if it goes through the RL10, you short it again. So this is shorting it in the pocket, and that's shorting it with a collapsing dragon. So this SSC is actually kind of a universal pattern that says if it works, if this thing goes all the way through the dragon and it works, it's going to be great. But if it fails, it's going to fail pretty soon through the bottom of the RL10, and then I'm going to have a collapsing dragon. And that makes this little region inside here, you have a very tiny, what we call the yellow zone. That's the region of indecision. It's indecision because the sell-off has terminated and it's starting to retrace. Is it going to work? I don't know. It's in the indecision zone. So before it gets too far, I'm going to have a very tight risk box, and I'm going to get long when it crosses the dragon. And my execution risk is going to be if it violates the previous swing low of the RL10. So my risk box is small, and my potential reward is large in that direction and large in this direction because of the size of the previous sell-off. The size of the previous sell-off says that that there's really good reasons why this thing is weak. And everybody that was short sees this as an opportunity to short it again. It's like they're shorting a dead cat bounce. Sometimes that dead cat bounce works. Other times it fails. So just treat it as a coin flip. It's just a coin flip. Half the time it'll work this way, half the time it'll work that way. I don't know what the stats are, but if you treat it like a coin flip, you don't believe that the side that you took is the correct one because you know how easily it can reverse and go the other way. But it doesn't matter. All you did was you put a small ante in here of your core capital, and then as soon as you can, you get your risk out. Man, I should be charging you $5,000 for this. It's ridiculous. As soon as you get your risk out, then you have protected your core capital, and now it's just a science project to see how much you're going to gain. So there you are. So QAw02 is this idea of rising lows and rising highs, and you're buying on the resumption of the primary trend. It's just a precise, calculated way to buy dips in a rising market or to short fails in a falling market, because QAw01 works exactly the same way on the downside. And so when the SSC fails, when it fails inside this yellow zone, right? So when our little risk box inside here, inside that yellow zone, it's a very small region where it's trying to recover. So if that price fails, it starts retracing and then it fails out of there, you're short. And that looks like big sell, a little and big sell again. So you can get short in the pocket, or you can just wait for the collapsing dragon. Collapsing dragon enters here when it actually violates below the RL10. But if this thing doesn't even get to the dragon, like for the SSC to execute, the RL10 has to get across the dragon, then you can execute here. But what if that thing reverses, gets to the edge of the dragon and starts to fail? Well, that's good, because that means that the sellers who just punished it with this horrible sell-off are winning, and they took this as an opportunity to add to their shorts, and they're crushing all the buyers, and there's no other buyers. So don't be a buyer, be a seller. And you can get short in the pocket, or you can just wait for the collapsing dragon and get short here. Two different places you can get short. But you want to get short not later than a violation of the RL10. Now, why is that a good idea? Here's why that's a good idea. And this will be probably the last idea for today. Oops, let me get my eraser on here. Come on, Kenneth, pick the eraser. Here's why that's a good idea, and this is the power of regression lines. I'm never again going to sell this course for $1,000. It's ridiculous. All right, so you got price going down in these bars, right? And maybe one of those bars looks like that. Well, the RL10 is a smoothed regression. It's a smoothed moving average, right? So that RL10, when you compute that, it looks like this. And now suppose that, that price now starts going, let me get that price here. So now price starts going up. Yeah, let me just, because I want it to fail here pretty soon. Just remembered. Well, because that RL10 is pretty time sensitive, it will, God dang it, make this smaller. It will adapt pretty fast and start tracking back up like this. So what you'll notice is that on this last bar, that price actually went down an extra little bit, but the bottom of the RL10 was only right here. So this is the statistical pivot. Think of that as the place where statistically is where the pivot occurred, the swing low. But people that are not using regression lines are saying, well, they're going to wait and see a new low and they're going to wait for the bottom of this last price bar. There may not have been a lot of volume. So this was pretty low volume is in here, most likely. So when the bottom of the RL10 is violated, we have enough information that the resumption of the downward pressure has started to occur. And it's really all of the reasons, whatever the reasons were, and we don't even know or care why it was selling, the fact that it was selling was enough. So this great big selling pressure, there's selling pressure pushing this thing down and down and down and down. And then it got to some level that attracted the buyers. And so then buyers saw this and said, aha, we're going to start bringing in some buying pressure and put it up. But they only had enough power to move it this high. And then maybe they ran out of gas. And now the sellers say, we can now start shorting it from here instead of getting short down here. So they look at this as an opportunity to add short positions, like a dead cat bounce. So the very fact that there was some success to the upside attracts more sharks. And then these guys come in and they start pounding it again because they remember what it was like to make a lot of money on the short side. And here's a chance to get short on a dead cat bounce. So when you take an SSC or a washout pattern or whatever you're doing, then you got to recognize that when you've made your money inside here, that the very success that you have is going to attract more of these guys that were here on the downside. And so what you have to hope is that the success that you have here is going to bring in even more buyers that can defeat the short sellers. And so that's why a lot of times you'll see the initial surge and then some more sideways chop as the buyers and sellers adjudicate. And then if the buyers win, it goes up. So you end up getting something like multiple legs to the upside. You might actually see leg 1, leg 2, with some kind of pause here in the middle. If there was not much retracement, right? If there was not a lot of retracement in here, it just kind of oscillates a little bit and then starts to resume. That's like a buy on this failure to fail. You just kind of draw that solid line underneath there. It couldn't fail through that line. That's a reason that makes this. You'll end up seeing that as a QAw01 after an SSC. But that's not the only time QAw01 happens. QAw01 can happen when you just see this long, rising, grinding bull, and all these little dips keep making higher lows. And as long as you can see higher lows in all of those, and you're seeing higher highs, you have an upward grinding channel of higher highs and higher lows. And that means you can start buying these little intra-channel reversals. That's also what QAw01 does. So the first thing you learn should be supported spring crossing, then the collapsing dragon. So when it fails, you can get into even better trade. And then to the upside, QAw02, so that you can reinforce success on an SSC. Eventually, this will lead to an owl. And then sometimes this upward grinding move will get you into a sideways quiet channel. And then things will stabilize for so long that the Z3 lines pinch. And then this SQC, which is not tradable, will become a Z3P critical state, which is tradable. So now you've seen the entire conceptual framework of generation 2 of the RLCO Bollinger Band. This is called, we're calling this basically critical state trading. And we're using these kind of standard patterns, and we're using the RLCO Bollinger Band MACD histogram 4 seasons as a sense-making framework that allows us to engineer the size of these trades, the reward and the risk, with very careful precision. Very precise, which means that we know exactly, we already know when this RL10 reverses, and before it even enters, we already know where we're going to get out and if we're going to stop and reverse. We know that, in fact, you can already put that as an order in so that if this thing doesn't even hit your entry and just immediately reverses, you've already got the order in to go short. So put your order in to get short before you even enter, and now you don't even have to do anything except enter the position and then manage to get to no lose plus dinner for 2. You got one decision to make. Simple, violent, robust, and professional. And then you trade that with a position size that will keep you in the game, that doesn't cause you to lose your mind, so that you can take 20, 30, 40, 50 trades a day. And then, if you're executing the rules, you will get the expectancy of the system, and you're not relying on any one trade to be the most brilliant one. It's like you're going to play 1,000 hands of poker. The only time you ever go all in on poker is when you know you have the nuts. Meaning that mathematically, you can't lose the hand. Because unlike the World Series of Poker, they keep raising the blinds, so it puts you under pressure. Your chip stack is decreasing faster and faster as the blinds go up because they want to create drama. I don't want to create drama. I'm just going to play at a level where I can play 1,000 hands in a row the same way that I'm going to trade the first one. And I trade them according to those rules, and I execute. So watch that 2-hour battle drill every day for 30 days. And if you're not sick and tired of it by 30 days, watch it another 30 days until you're absolutely sick and tired of it. Then you've watched it enough. All right. That's everything I got for today. We got work to do, and you got videos to watch. Okay? Well, there's a couple other guys that are in the foundations course that are in Europe, so I'm just going to keep that open for them. If nobody shows up, there won't be a second recording, but this one is probably worth having them listen to it again because it gives them the secret sauce for the SSC, and they're entitled to that. So, so there we are. Last chance for questions. Denny, does that make sense to you? Lynn, does that make sense to you? Okay, good. Hey, I'll get this published and posted. I'm going to hang it on that right board in Basecamp again. Yeah, just so you guys know, this is the last time I'm selling this course for $1,000. You are getting a real deal on this one. So anyway, take good care and have a good rest of your Sunday. Okay. Oh, once you get post those in Campfire, Matthew. when you put your, there's actually there is a room in Campfire strictly for the SSC. It's called the SSC Challenge for EWZ and DIA. Post them in there, and then you can actually go look at other people do it. The people that do that learn how to trade the system pretty quickly, and then you'll be ready to do some bar by bar coaching once you get that done. Okay. All right, that's everything I got. You guys take good care.